Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, both bonds and stocks gained a good amount in the third quarter. Inflation remains muted, lower than 3%, heading towards the 2% Federal Reserve target. It was 2.4% in the September Consumer Price Index. Wages are growing at 4%, playing catch-up. You'll have noted the dock workers' union agreements, the ongoing Boeing workers' strike, Summer's Hollywood Studios agreement, and others, all raising wages. The unemployment rate has oscillated around 4.1%. The labor market remains healthy enough. The Federal Reserve reversed course in September and cut short-term interest rates by 0.5%. At quarter end, U.S. large companies were up 21% year-to-date. Small companies were chasing at 11%, and stocks of overseas companies returned 14%. Bond yields are a moving target lately, but bonds gained 4.6% by quarter end. The Federal Reserve seems to have achieved a rare soft landing so far, reducing inflation by slowing the economy, but not triggering a recession. Most pros agree. September's jobs report was strong, showing good jobs growth, 254,000, low unemployment. The recent JOLTS report shows over 8 million job openings. Pros have been guessing what future rate cuts are coming from the Fed. Some want large interest rate drops sooner to spur the economy, but without triggering inflation, of course. Most pros predict a continued slow decrease in short rates down to the mid 3% or so, what's termed the neutral rate, over the next couple of years. We'll see. The U.S. economy grew a revised 3% in the second quarter and is forecast for a 2.7 to 3% pop in the third quarter, perhaps resulting in 2.4% GDP growth for the year. Those are all solid numbers. Consumer spending, 2/3 of our economy, is doing well. August retail sales were up. In the end, we care about interest rates and corporate earnings. Rates are coming down now. Corporate earnings have been healthy. Earnings rose 6% in the first quarter, 13% in the second quarter, and are estimated to grow 5% third quarter, and 8 to 11% for 2024 overall. The stock market is priced at 22 times expected earnings, which is hitting the top of the historical range. Most of that exuberance is concentrated in a handful of technology stocks, the Magnificent Seven, due to optimism on artificial intelligence. Small U.S. stocks have not followed suit. Lower interest rates should help them because they borrow more. A few pros still predict a recession, and we are due for a correction at some point. It's difficult to see how the stock market can reach new highs unless corporate earnings kick in again, and they may. A bumpy trend sideways seems likely for the near term given the November election in the U.S. If the outcome is strongly contested at length, the markets will be at risk. Note that who wins doesn't matter much historically. Geopolitical risks exist overseas, but a direct material impact on our markets is unlikely. Interest rates and inflation are lower in Europe. Their unemployment rate is higher. Economic growth is lower there. They have more regulation. Living and working amidst two wars in Ukraine, Russia, and the Middle East are obstacles. Their stock market's returns are lower. China decided last month to add stimulus to their economy. Their markets jumped and then pulled back. We invest little there. China's 5% economic growth exceeds ours. As long-term investors, we know from historical data that diversifying among markets geographically, among large and small companies, and among companies on the leading edge going fast, and companies steadily moving forward paying dividends, is a proven path. Proven to give us the leaps in returns and to mitigate the downside during recessions and corrections. Most of us have invested 2/3 of our money in this fashion, spread out. We do the same with bonds, spread over more conservative short-term low-risk segments and on into the higher-risk corporate some high-yield segments. That approach has better odds than playing hunches. Retirement is a long game. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.